Good evening and welcome back. Am I audible?
Yes, sir. Good evening.
Good evening.
Good evening, sir.
Shall we start?
Yes, sir.
Okay. So let us start with our discussion. So I think last class we have already started our discussion with principles of investment, fundamental principles of investment, and various steps of management of investment. Isn't it? Is my screen visible?
No, sir. No, sir.
Yes, now it is visible.
Now it is visible. Okay. Okay, good. So these are the things we have already discussed in our last class, steps in the management of investments. So generally, as an individual investor or institutional investor, so whenever we are managing the investments, we have to follow these three steps. First step, we need to determine the objective of the investment. On the basis of that, we need to determine the investment policy. Okay. And in second step, we need to determine the that means a review of investment needs. Okay, why there is need of investment, we need to review. So after that, in the third step, we need to again formulate the investment portfolio policy, because whenever we are talking about portfolio, it is the combination of securities in a particular basket of investment. Okay, so today we'll start with security analysis, then portfolio management, and various phases or various steps of portfolio management we'll discuss in detail. So I hope my screen is visible to all of you.
Yes, sir.
Okay. So let us first understand, because we are going to discuss about security analysis and portfolio management. So we must understand what is security analysis, then what is portfolio management, and what are the various types of risk and return involved in the portfolio management. We'll discuss in detail. Okay. So what is security actually? Please remember, whenever we are talking about security means what? It may be any kind of stock, share, debenture, etc. So generally, whenever we are talking about security, please remember these are the financial assets or financial instruments. Okay, so we have already discussed about the kinds of asset. The asset may be financial asset or it may be economic asset. Financial assets are the securities like stocks, shares, bonds, scripts, etc. So whenever we are talking about security means these are the financial instruments or financial assets. It consists of shares or stock. Then it consists of your debt instruments like debentures and bonds.
Sir?
Yes.
You have written script. What is that?
Script.
Yes,
Try to understand. Script means actually what? It is the provision, one kind of provisional certificate issued by a particular banker or particular company to the investor. Let's say you are the investor. Whenever you are investing your money in any financial institutions or any company or corporate, sometimes what happens actually, the corporate may issue you a provisional certificate. That is known as script. It is also coming under the category, coming under the category of what we could say securities. Okay, is it clear?
yes, sir. Thank you.
Okay, so the Securities Contract Regulation Act 1956 actually define the meaning of security. Security means what? It inclusive. That means consists of shares. Shares means equity shares and preference shares. It consists of scrip. Scrip means a financial instruments that is issued by a institutions to the investor. So it consists of shares, scrips, stock, bonds, debentures, stock, or any other marketable instruments. Marketable instruments means what? Which are meant for buy and sell. Which are meant for buy and sell. Let's say you are holding one equity share. You can buy the equity share and you can also sell the equity share. So that's why it consists of all these instruments along with the marketable instruments of a like nature or of any debenture of a company or body of corporate, the government or semi-government bodies. Okay. When the debt instruments are issued by a corporate or private entities, these are known as debentures. But when the debt instrument is issued by the government or semi-government bodies, this is known as bond. So there is only the little bit difference between bond and debenture. Please remember, if the private entity is issuing any debt instruments, it is known as debenture. If any government entities or semi-government bodies issuing the debt instrument, it is known as bond. So let's say RBI is issuing. So RBI is one government entity, autonomous entity, autonomous body. There, okay. Suppose government corporation or organization is issuing any debt instrument, it is known as bond. If private body is issuing the same instrument, it is known as debenture. Okay, so debenture carries a fixed rate of interest. Please remember, that is known as coupon rate of interest. So did you understand what is security? Security means what? It consists of the financial instruments or financial assets. So what are the financial instruments or financial assets? So these are the capital market instruments as well as money market instruments like shares, scrip, stock, bond, debentures, or any other marketable instruments. Okay, or any other debenture of a company or body of corporate that is issued by that may be issued by also government bodies or semi-government bodies. So this is all about security. Now let us understand what is security analysis, because our subject is security analysis and portfolio management. So we must understand analysis. Please remember, the process of analyzing the individual securities and market as a whole and estimating the risk and return expected from each of the investment is known as security analysis. What does it mean? The process of analyzing the individual security. Individual security means an equity share, maybe individual security. A particular company preference share, that may be individual security. A particular company may be individual security. So individual security can be analyzed with the market as a whole. In the market, so many securities are available. So what is the market rate of
स्लाइड चेंज होनी सर स्लाइड टा चेंज होनी
slides change होनी?
ना सर ये सिक्योरिटी रही अच्छी
So security नहीं अच्छी. What happened actually? Now you just see. Is it visible right now?
यस सर
Yes.
Security analysis.
Yes, sir.
Security analysis visible? This slide? This particular slide. Is it visible?
यस सर जस्ट नाउ
Very
इट्स
good.
विजिबल
So security analysis means what? The process of analyzing the individual security. Individual security means what? It may be an equity share of a company or a preference share of a particular company or entity, or it may be debenture or bond-like instrument. So that individual securities can be compared with the market as a whole. Why we are comparing? Whenever we are comparing, by comparing, we can able to estimate the risk associated with the security and the return expected from the security. So that's why security analysis is there. So very simple example we can take. Let's say Tata Steel, one company is there, it is issuing the equity share. So Tata Steel equity shares are there in the market, and in market so many equity shares are available. So right now, if you will see the market scenario as a whole, let's say what is the degree of risk involved in the equity instruments and what are the expected return the investors are getting once they are investing their money in the equity instrument. So the market is saying that degree is this much and return is, let's say, 10% or 20%. So side by side within this equity market, so many equity instruments are there. You can able to analyze the individual equity share. Individual equity share like your Tata Steel equity in the market as a whole. Why we are analyzing? We are analyzing in order to estimate the risk associated with the security and return expected from the security. Security means investment instruments. Is it clear? Did you understand?
यस सर
Okay. So this is all about security analysis. Next, let us discuss about the portfolio. So portfolio means what? I have already told you about the portfolio. Portfolio means what? It is the collection and combination of financial assets or financial instruments. So you have to create a particular investment basket where you are going to put the financial instruments. So what are the financial instruments? It may be capital market instruments, it may be money market instruments. So let's say you are creating a particular basket. In that basket, you are putting shares, some preference shares, some debentures, or some government bonds, etc. Okay, so whenever you are putting all types of financial instruments in a particular basket, that collection and combination of all the clear. Did you understand? What is portfolio? Portfolio means collection and combination of financial instruments. Combination of financial instruments in market instruments, because investing your money. So that instruments you need to pick and you have to put in your basket, investment basket. The combination, whole combination of your investment basket is called as portfolio. Did you understand, everyone?
Yes, sir. Yes, sir.
Yes or no?
Yes.
Yes, sir. Good evening, sir.
Yes.
Portfolio management. What is portfolio management? No, what is portfolio? Portfolio of financial investment basket or basket of investment.
ଟିକେ ବ୍ରେକ୍ ହଉଛି ଆପଣଙ୍କର
Voice break ହଉଛି,
ଆଜ୍ଞା ସାର୍
but your voice is clear to me.
No, sir. ଆପଣ side ରୁ voice break ହଉଛି sir.
ମୋ side ରୁ କିଛି glitches ରହୁଛି?
ହଁ ସାର୍
ଆଚ୍ଛା, now you just confirm.
ଆଜ୍ଞା ସାର୍ ଆପଣଙ୍କର ଭଏସ୍ ବ୍ରେକ୍ ହଉଛି
Okay, now
Clear,
am I
sir?
audible right now?
Yes,
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 sir.
sir.
Yes, sir.
Is my voice clear to all of you?
yes sir
Okay, thanks so much. Okay, so we have already discussed about portfolio. Now we are going to discuss about portfolio management. What is the meaning of portfolio management? So it is the investment of fund in different securities in which the total risk of the portfolio is minimized and expected rate of return is maximized. So we have to pick some securities and we have to put all those securities in a particular basket. What is our intention or what is our objective? Is to minimize the risk associated with the portfolio. That means investment basket, and maximize the return. Okay, so that is known as portfolio management. Is it clear? Did you understand what is portfolio management?
Yes, sir. Yes,
ସାର୍
sir.
ଟିକେ ଆଉଥରେ କୁହନ୍ତୁ ଫାଷ୍ଟରୁ ଶୁଭିଲାନି ଭଏସ୍ ଟା ବ୍ରେକ୍ ହେଲା ଆପଣ
पोर्टफोलियो मैनेजमेंट कहले कोन हमें बुझिबा माने करंतु आपण गोटे इन्वेस्टमेंट बास्केट क्रिएट करूछंती सेहितरे कोन मार्केट पिक करूछंती इन्वेस्टमेंट बास्केट माने कोन आपण डिटरमाइन करछंती जे आपण पाखरे लाख टका अछि लाख टका आपण इन्वेस्ट करिवे सेतिरु माने करंतु आपण 30 टका रो इक्विटी शेयर किनुछंती 20000 टका रो प्रेफरेंशियल स्टॉक किनुछंती आउ 30000 सपोज आपण डिबेंचर किनुछंती आउ जो 20000 रेस्ट अमाउंट रहला तार माने करंतु मनी मार्केट इंस्ट्रूमेंट किछि किनुछंती ओके तो आपनकर वर्तमान कोन हला पोर्टफोलियो बास्केट क्रिएट हे गला सो पोर्टफोलियो बास्केट क्रिएट हेला परे तापर हमें कोन करबा वी हैव टू मैनेज द पोर्टफोलियो that is known as your portfolio management. Why we need to manage? We need to manage the portfolio in such a way so that at all point of time our risk of the portfolio should be minimum and expected rate of return should be maximum, so that we can say that our portfolio is one optimum portfolio. Are you getting?
yes sir
So this is known as portfolio management. Is my screen changing?
No,
Screen
sir.
change होगी ना नहीं?
No, sir. No,
No.
sir. No, sir.
Okay. Then I am quitting from this slideshow. You just see right now. Is it visible right now?
Yeah, we are now able to see that need for portfolio.
Okay, very good. Because I have already discussed about what is portfolio management. Portfolio management means what? You have to create a particular portfolio, that means investment basket. After creating the investment basket, you have to arrange your securities within that basket in such a way so that your risk of the portfolio should be minimum and expectation of the portfolio should be maximum.
Yes, sir. Correct, sir. Correct.
Now let us talk about portfolio. First and foremost point is that is minimization of risk and maximization of return. If we are creating a particular portfolio, then at all times we can able to minimize the risk and maximize the risk. Maximize the return. If we are unable to minimize the risk, how you can minimize the risk? By diversifying your portfolio, you can able to minimize the risk. Okay.
Correct.
Suppose right now equity market is in volatility in nature. Volatility means fluctuation of return is there. You can withdraw your money from equity market and you can invest your money in the market. So as a result, you are diversifying your risk. So risk will be minimum. And side by side, you can also check your return. How to maximize the return? So first and foremost need for portfolio is to minimization of risk and maximization of return. Please remember, that's why this subject is important. Otherwise, this subject is having no relevance. The main reason behind this portfolio management is that minimization of risk and maximization of return of the portfolio. Okay.
Yes, sir.
Next,
Yes, sir.
need is provide regular or stable income. As an investor, whenever we are investing, we all need return. We all expect return. Yes or no?
Yes, sir.
So whenever we are expecting return, so we need to undertake the risk. We have to assume the risk because
Yes, sir.
risk and return are correlated. Okay.
Yes.
So by taking minimum risk, we always want maximum return. So
Return.
maximum return means what? That return should be stable or regular. Suppose we are investing in some investment avenues. On the basis of that, we have already created our portfolio. That means our portfolio should give us stable and steady return at a regular basis or regular interval. Let's say per annum I need 2 lakhs of return or 20% of return. So I must design, I must create my portfolio in such a way so that it can give me regular or stable income. Stable means steady income. Okay. That doesn't mean that it is just like your salary. Suppose you are withdrawing salary of 80,000 per month. So it is not like that 80,000 it will create. So sometimes it can give you 85,000, 82,000 or 90,000. Sometimes also it can give you 75,000, 78,000 like that. Then only you can say there is a stable income. And next one is creating safety of investment. If you are managing your portfolio in a proper manner, you can able to create the safety for your investment. Because whenever you are managing your portfolio, that means you are changing the security pattern. Security pattern means the financial instruments you are holding or putting in your portfolio. You are changing on the basis of risk and return. Okay. So whenever you are changing, definitely you can be able to manage your risk so that you can able to create the safety for your investment. Again, portfolio provide marketability and liquidity. Marketability means what? Buying and selling can be taken place at any point of time. You can buy, you can sell. There may not be any restrictions or any barrier in order to conduct these activities. Then only you can say your investment instruments are having some sort of marketability. Easily you can able to transfer whenever you are transferring your investment instruments, you can able to get back your money. Liquidity means what? As and when you need cash, you can able to sell your securities or investment instruments and you can convert it into cash or cash equivalents without loss of its value, or if there will be a loss, may be nominal amount of loss. Clear? Did you understand, everyone? Why
Sir,
there
what
is-
are the cash equivalents?
Which one?
Cash and cash equivalents. Which are the cash equivalents?
Cash?
Equivalents.
Cash equivalent. Very simple example about your cash equivalent is your what you can say, check or DD.
Okay, sir. Got it.
Who has issued you a check, banker's check? You know banker's check?
Yes, yes, yes.
DD.
Hmm.
Is it cash?
No, it is cash equivalent. Okay, fine.
But this is equivalent to cash. You can
Yes, sir.
convert it into cash very easily.
Right.
Yes or no?
Right, right, right.
Chalo. Next, this is very, very important. Try to remember. So, Ashutosh Sunanda sir is asking, cash and cash equivalents are the most liquid current asset found on a business balance sheet. Okay, current asset. Good. Chalo. So, you need to remember these 5 steps because your entire syllabus is within these 5 steps of portfolio. So what is step number 1? Step number 1 is about security analysis. Okay. And step number 2 is all about your portfolio analysis. Step number 3, portfolio selection. Step number 4, portfolio revision. And step number 5 is all about portfolio evaluation. So step by step, we need to follow these 5 steps for portfolio management. So first we need to analyze the security. Security means individual security. Please remember. Whenever you are acquiring or buying any equity share or preferential any debt, instruments or bond, like so here equity share, debenture or preferential stocks, these all are known as individual security. So whenever you are buying, individual securities must be analyzed. So whenever analyzing these individual securities, what you are analyzing? You are analyzing what is the degree of risk associated with this individual security and what are the expected rate of return. Okay. Did you understand? So for that purpose, you need to go for security analysis. Let's say I want to buy the equity share of Reliance Industries Limited. So here Reliance Industries Limited is the company. So it is the issuer, its stocks are available in the market. Okay. So I am just buying the stock of Reliance Industries Limited. So whenever I am going to buy the stock of Reliance Industries Limited, that means equity share or debenture or preference share, whatever it may be. So in that case, I must analyze the equity share of Reliance Industries Limited. How I have to analyze? I have to analyze the individual share with the market equity instruments or preferential instruments or debt instruments as a whole by considering the risk and return. Okay. What is the amount of risk associated with the Reliance Industries Limited stock and to get acquiring this stock. So on the basis of that, first you need to make the security analysis. After making the securities analysis, that means individual security analysis, what will do? You have to create a particular portfolio. Portfolio means what you can say, investment basket. You need to create a basket. Basket, you have to buy the securities from the market and put your securities into that basket. So let's say I have already created a particular basket. The total amount of my investment basket is, let's say, 1 lakh. Out of 1 lakh, I need to acquire 30,000 equity shares, amount of 30,000 equity shares, another 20,000 preferential stock, another 50,000, let's say, debentures. Let's say. So here, whenever we're going for portfolio analysis, what we'll do? I have to pick the individual security on the basis of analysis of return. So after putting into my investment basket, that portfolio, again, I have to analyze my portfolio. How to analyze? So after combining the risk of each and every securities, I can able to get what is the risk associated with my portfolio. That means entire investment basket. And what are the expected return of my portfolio. So on the basis of expected return and risk of the portfolio, we can analyze our portfolio. That means investment basket. So after portfolio analysis, next step, we need to go for portfolio selection. On the basis of that, we can select a particular portfolio which can give us the maximum expected return and minimum risk. On the basis of that, we have to select. Select means we need to select the securities and we must put all the securities into that basket. Okay. So that is all about portfolio selection. Right now, you have already selected your portfolio. But can you say that your portfolio is your portfolio fixed? Is it fixed?
No.
Why?
We can so change also as per your market.
We need to diversify it.
Yeah,
Why you need to change or why you need to diversify?
because
That is
that's why the portfolio management we have to analyze that if there is any different type of portfolio and one portfolio is going down as per market, we can just divert it to another as per current
okay. That means
return.
if that risk is changing, that means
Yes.
and decreasing of the return. At that time, some securities you have to sell into the market, and instead of that, you can buy the other securities and put all other securities in your portfolio, so that you can able to revise your portfolio. You can able to revise your portfolio. I have already given an example to you. Let's say equity is one of the fluctuating market right now. So what will do? Able to predict the risk. You cannot able to predict the expected rate of return. In that case, it is better to sell shares or equity instruments. And instead of equity instruments, you can buy the debt instruments or preferential stocks. So whenever you are doing these activities, automatically your portfolio will be revised.
Yes, sir.
Yes or no? So there will
Yes,
be revision of the portfolio. Why revision of the portfolio? Revision of the portfolio is required in order to determine the optimum risk and return. Optimum risk and return means risk should be minimum and return should be maximum. Okay. So after portfolio revision and final step, you have to evaluate your portfolio. Portfolio must be evaluated. So that's why portfolio evaluation is there. How to evaluate the portfolio? That means entire portfolio risk you need to determine and entire portfolio expected return you need to determine. So that you can say that this is my expected rate of return, and in order to get this expected rate of return, I must be ready to undertake or I must be ready to assume this much of risk. Okay, so that's why portfolio evaluation is must. Otherwise, what will happen?
Then
Will incur loss.
so that then we cannot minimize our risks.
You can minimize your risk.
Yes.
If risk will be more, suppose everybody wants more return, you need 50%. Whenever you are expecting 50% rate of return, side by side, you need to undertake the risk.
Exactly, sir.
So whenever you are going to undertake the risk, you must have some risk absorbing capacity, risk appetite. Okay.
Yes,
Up
correct,
to
sir.
what extent you can able to observe the risk or you can able to undertake the risk.
That means
Beyond
it
that, if you
helps.
are undertaking the risk or assume the risk, at any point of time, you may collapse. That means your portfolio may collapse.
Okay,
So
sir.
if your portfolio is collapsing, what will happen? Reverse situation will happen. That means risk will be more and your return will be very, very less. Is it clear?
Yes, sir. That means portfolio evaluation helps to identify unperforming asset. Am I right, sir?
Yes.
Okay.
So whenever you are identifying, in that case, what you need to do? You need to evaluate the degree of risk side by side. You need to find out or determine the rate of return.
Correct.
Oh,
Yes. Any query?
No, sir. Clear.
Sure. So this is all about the phases or steps of portfolio. Is it clear to all of you? So we have already discussed about what is security analysis, what is portfolio management, why there is need of portfolio, and what are the various phases or steps involved in the portfolio management. Is it clear?
Yes, sir. Yes, sir.
Up to this? Chalo. Next, we are going to discuss about risk. Any idea? And I hope you have the term about uncertainty. Yes
Yeah,
or no?
yes, sir.
Are they same?
Yes, sir. We can say in that way.
Risk is there, uncertainty is there.
Yes, sir.
Risk and uncertainty, are they same?
Yes, sir. We can say that.
You can say that. Is it so?
So
Please
risk where we want to take, and uncertainty is a natural way which comes.
Acha, natural way which comes.
Means where
Okay.
when any
Very
war will come out, then
okay,
market may
okay,
go
Vijay
down in
Lakshmi.
that area.
Okay. Let's say you are Vijay Lakshmi madam, you are an investor, individual investor, you are investing your money. So whenever you are investing your money, you want to undertake or you want to assume uncertainty.
No,
Then
ma'am. No, sir. We can't assume uncertainty, but
is it so?
uncertainty must be there.
Uncertainty, is it so? So whenever we are investing, we are dealing with the risk and risk and return. That means we are expecting return means we have to assume the risk.
Yes,
Okay.
sir. Yes.
So in investment, we are talking about risk, but we are not talking about uncertainties. Isn't it? That means you have to assume the risk. You must assume the uncertainty.
Yes.
Why? If you are assuming the uncertainty, then you cannot able to predict your result expected return. In uncertainty, what happens actually? Your results are unexpected. Let's say we are driving our vehicle, we don't know. Accident may happen at any point of time. Yes or no?
Yes, sir.
If accident happen, this is uncertain event. This is due to uncertainty.
Yes, sir.
Yes or no?
Yes.
But whenever
Yes,
we
sir.
are driving our vehicle, we know risk is there. What are the risks? What are the risks? The
There is a
vehicle,
chance of
Accident may
accident, sir.
happen.
yes, accident may happen. The vehicle
Yeah.
may create any problem at any point of time.
Yes.
But side by side, if you are following the traffic rules and if you are maintaining your speed limit, automatically you can able to minimize.
Manage the,
Uncertainty.
yes, minimize the risks.
Yes, sir.
Are you getting my point?
Yes,
sir.
yes.
So the same thing happens in case of also investment. So in investment, we always assume risk. Risk means what? Please remember the probability that our expected return from the security will not materialize. We are expecting that we are going to get 20% rate of return, but we could not able to materialize that 20% rate of return. Why does this happen? This may happen due to micro factors or macro factors. Micro or macro factors. Please remember. So expected outcome is less or more what I have expected. Let's say I have already expected 20% rate of return. So I may get 22% rate of return, or I may get 18% rate of return, or I may get 15 or 12% rate of return. So if the variability of the return will be there, so automatically we can say there is the risk. So when the fluctuation of return is there, this happens due to risk, but this doesn't happen due to uncertainty. Okay, but what is uncertainty? So please remember, uncertainty means what? This is purely unexpected outcome. No one is expecting. So unexpected outcome will be there due to random variation of results. Let's say we are investing some amount of money, we are expecting 20% rate. War like may rise, or in what do you say? Natural maybe there. So these conditions, because of these unexpected events, we may also expect some unexpected outcomes. So because of this unexpected outcomes, what will happen? Random variation of result will be there. Expecting 20%. Sometimes we may get 0% rate of return. Sometimes the securities price also may come down. Right now we are dealing with 10 rupees per share. So because of the uncertainty, it may also going to be negative. So uncertainty means what? Unexpected outcome due to random variation of result. Please remember, it is due to external factors. What are the external factors? It may be economic factors, it may be political factor, it may be industry factor. We are the investor. We are buying the share. Where will let's say I am an investor. I am investing my money in the equity share of TCS. Let's say Tata Consultancy Services. So TCS, it is coming under IT sector. Yes or no? If the last, so what happens to TCS? Automatically TCS will also incur some amount of loss. Yes or no?
Yes, sir. Yes.
So this happens due to it may be economic factor, political factor, or maybe industry factor, or other factors may be also there, like your natural calamities or like situations and okay. So most important difference between risk and uncertainty is that risk can be measured. Please remember, but uncertainty cannot be measured. Are you getting my point? So yes or no?
Yes, sir. Yes, sir.
Investment risk is there. We can able to assess the risk. We can able to evaluate the risk. But in case of gambling can also give you the return. But here, risk cannot be assessed. You cannot getting what am I actually? Uncertainty is there because we cannot able to predict the result because of the unexpected outcomes. Unexpected outcomes. Okay. So this is the basic difference between risk and uncertainty. So here we are not talking about uncertainty because in investment we are always dealing with so we must discuss about risk. Yes, any query? Any query from
No,
you?
sir.
Sujit Babu?
No, sir. No queries.
No query. Okay. Let us discuss about this risk. So two types. Total risk may be used as specific risk, or total risk could be also market risk plus issuer risk. And total risk may be the systematic risk plus unsystematic. One way or other, all these risks, we can say all these three types, if we'll compare here, general risk is equal with your market risk. General risk may be equivalent with your specific risk may be risk as well as systematic risk. Okay. So here, whenever we are determining this total risk, we may consider general risk and we may consider specific risk. What is general risk? General risk means what? Risk which is available for all. Let's say in the market, investors are available. You are one investor, I am also another investor. Institutional investors are also there. So many investors are there. Whatever risk to you is available to others. It is coming to others. But the risk may be also specific risk. Specific risk means what it is? The risk associated with the specific security. Let's say X Limited, one company is for X is there. If you are buying X limited, you have to specific of X limited. Okay. But if you are investing your money in the equity market, so in entire equity market, risk is there. That is risk as a whole in the equity market is there. That is general risk. That is available for all the investors. So again, total risk may be market risk plus issuer risk. Market risk means the risk which is available in the market and which is applicable to the whole investors in the market. Issuer risk means here issuer means the company or the government or the semi-government bodies who is going to issue the security. Reliance Industries Limited, a Reliance company. Let's say it is issuing equity share. So Reliance company is the issuer. Tata Steel, it is another corporate or company. Let's say it is issuing one equity instrument or equity share. So that may be the issuer risk. That may be also the issuer risk. Just a minute. Okay. So total risk may be also systematic risk and unsystematic.
Sir,
Yes.
please, can you please explain issue risk again?
Issuer risk means the entity or the body of corporate who is issuing the security, it is having some risk. So that is known as issuer risk. Let's say Reliance company is issuing the security. Some risk is also associated with the Reliance company. That risk may not be associated with other company. So who is the issuer here? Because Reliance company is the issuer company because it is issuing the security. Are you getting my point?
Yes, sir. Thank you.
So the security which is associated with the issuer or the entity which is issuing the security is called as issuer risk. Again, total risk could be systematic risk plus unsystematic risk. What is systematic risk? Please remember, systematic risk is uncontrollable by an organization. This happens due to systemic crisis. When system failure will be there, let's say we are driven by the political system of a nation, economic system of a nation. If the economic system will fail, what will happen? Automatically, it will affect to the industry or the sector. Once the industrial sector will suffer, the companies, those who are coming under this particular sector, they will also suffer. So this happens due to systemic crisis or systemic failure. That is systematic risk. So systemic risk is uncontrollable by an organization or by an individual, and these are macro in nature. We cannot control, but unsystematic risk can be controllable by organizations, and these are micro in nature, not macro. It can be controlled. Very simple example I can say about your systematic risk. Let's say your financial crisis or economic crisis is there. So once economic crisis of a particular country will be there, so it will affect to all the entities, all the corporates, all the companies, and all the individuals and all the investors also. Yes or no? So that is macro in nature. Can you control the economic crisis of a particular country as an individual or as a body of corporate? The answer is no. But in case of unsystematic risk, if you are taking some precautionary measure, you can able to control. Very simple example. Let's say unavailability of your raw material, unavailability of labor forces or human resources. Because of that, your operational may be there. So because of your operational failure, the revenue may be fall down. Once the revenue will be fall down, what will happen? The company will report loss. If the company will report loss, so definitely or equity. Okay, so that's why risk could be general risk or specific systematic risk, systematic risk. So here general risk, market risk, or systematic risk, this is available to all. Are you getting my point? But this is specific. Simply you can say This is associated with a particular corporate entity or particular individual or you can say particular security. Did you understand? So there are in a nutshell, I can say there are two types of security. There are two types of risk. One is systematic risk, and second one is unsystematic risk. Okay. So investment, we must deal with this systematic. So what are the risks which are coming under systematic risk? Look here. These are the risks which are coming risk. Is my screen visible? Is my slide visible? Yes or no?
Yes, yes, sir.
Yes, sir.
Yes, sir. Yes, sir.
Which slide visible to you?
Systematic risks.
Very good. Under systematic risk, look here. These are the various risks which are coming under systematic risk. Market risk. Can you control? This is driven by the macro forces, macro factors. Interest rate risk. What is market risk? Please. Due to the market risk. If something will happen to the market, automatically there will be impact on the variability of the return of the security or of the investment instrument. So that is known as market risk. Again, interest rate risk. Due to fluctuation of interest rate, there may be certain risks. Interest rate may be the return of security. Okay. So this is an example aside. Let's say in money market instruments, what happens? Money market is controlled by RBI, Reserve Bank of India. Yes or no?
Yes, sir.
RBI is fixing all the rates, your repo rate, reverse repo rate, your base rate, bank rate, and others.
Yes, correct.
So because of these weapons of the RBI, there will be variability in the interest rate in the market. Because of that, your home loan interest, it may fluctuate. Your vehicle loan interest may also fluctuate. Your personal loan interest may also fluctuate. The same thing. Investing in any investment instruments, because of this interest rate variability, what will happen? It will have a significant performance. If the performance will be poor, automatically it will have some impact on its stock or securities. Yes, sir. So interest rate risk means due to fluctuation of interest rate, there may be chance of variability of the return. That risk is known as interest rate risk. Again, this is also known as inflation risk. Because the inflation in the market, what will happen? Purchasing power will come down. Once the purchasing power will come down, the spending will be less in the economy. Yes or no? So if the spending will be less, then the entities may not able to generate more amount of revenue. As a result, they may not able to report more amount of profit. So because of this, actually, there may be a risk on the securities of the company or stock of the company. Because here the company or the body of corporate or the government bodies, they are issuing the stocks. They are issuing the securities. It may be equity share, it may be preference share, or it may be debenture instruments. So purchasing power risk means what? The variability of the return due to inflation is known as purchasing.
विभूति कैसे?
Yes, please. Someone is asking something, I think.
I
No,
think
sir,
no
mic
person.
is on.
Oh, mic is on. Okay. So next one is regulation risk. So due to change in the regulation of a particular country or particular system, there may be variability of the return on the security. So that is known as regulation risk. So what are regulation risks? I have already told you or delivered you about the RBI, because RBI is the regulator in the banking sector. SEBI is the regulator in the sector. Yes or no?
Yes, sir. Yes.
At any point of time, if they will change the regulation, automatically there will be impact on the securities. there will be impact on the there may be impact. Come to your particular service. Next, international factors. So there may be the return due to international factors, so that be there. And it may also affect the security price in the market. What are the international? Can you write any example about the international factor? Export-import policy.
Yes.
Yes or no? Foreign
Yes.
exchange rates. That is
And
driven by international forces or national
political,
forces.
sir, can you consider political risks also? Interesting.
Political means international politics.
Yes.
So let's say our prime minister and
We
they
can
may sit in a particular place and they may discuss in the various business agendas
correct.
or economic agendas of our country.
Okay.
If there will be conflict, then automatically what will happen? Both the nations or both the countries may suffer.
Correct.
And international risk also arises, like let's say right now Ukraine war is going on, and Israel and another country, which one? Israel and I think Iran, and Israel and other country. What is that country? Actually, I forgot. So anyway, because of these situations, actually what happens, there may be some international forces which will have some impact on the business or corporate. Automatically, it will hamper the corporate performance. As a result, the return will vary. Okay, so this is coming under international risk. So these are the various types of systematic risk. So please remember, what are the risks under systematic risk we have already discussed. All are driven by the macro forces or macro factors, not micro factor. Is it clear?
Yes, sir.
Okay. So next one is about unsystematic risk. So as I have already told you, unsystematic risks are controllable by business organizations, and these are micro in nature, like your operational risk. Let's say one company unable to smoothly conduct its operational activities, like your production process, or you can say procurement of raw material, and retention of your labor forces. So these all are coming under the operational activities. Arranging of cash in order to maintain the production process. So because of this mismanagement, there may be operational risk. So operational risk, what is operational risk actually? Due to the mismanagement of the company or corporate, there may be variability of the return. That is coming under operational risk. What is liquidity risk? Liquidity risk means what? At any point of time, if the stocks or the shares or the investment instruments cannot be converted it into cash, then we can say that it happens due to liquidity risk. So what is financial risk again? Financial risk may be the risk arises due to the mismanagement of the finance by a corporate entity. Again, business risk is also another type of risk which is coming under unsystematic risk. So if any business is unable to manage itself, then there will be variability return. So if the variability of the return will arise due to mismanagement of the business, then it is your business risk. Default risk means what? When the business is taking some amount of money from the outsider, but on the other hand, it may not able to fulfill its commitment. So this happens due to default risk. Suppose I am an investor, I am buying the equity share, next day, say 10,000, and at any point of time, whenever I am going to get back my principal, if I am unable to get back my principal or return out, then simply I can say this happens due to default risk of that particular company or particular business entity. So all the risks which are coming under this systematic risk, these are driven by the micro forces or micro.
Sir, Can
Yes,
you please the default risk again, sir? We are unable to hear. Someone mic is on, sir.
Okay, whenever you are asking any queries, please switch on your mic, but in the rest of the time, you just switch off your mic. Okay,
Sir,
don't create any noise. Anyway, okay, good. So these are the various types of risks which are coming under. Someone is saying something.
no, sir, someone's mic is on. Sir, can you please repeat the default risk again, sir?
Okay, okay. I'm repeating.
Jagyasini madam, please switch off your mic, please.
I okay. Then you can unmute and you can ask. No issues at all. Okay. Because background noise is coming. So you are asking about default risk. Default risk means what? Let's say you are an investor, you are buying the stock of a particular company. Let's say that company is X Limited. So today you are putting 10,000. That means at the end of the maturity period, what you are expecting? You are expecting your principal amount. That means 10,000 along with your return. If that company will able to repay your money, then this happens due to the default risk. If the issuer means the company or the corporate entity who is issuing the equity, it is unable to pay its obligations. What is the obligations? Your amount of money. You have already invested 10,000 in the equity share of a particular company. The company, suppose you are right now selling your equity share. So after 1 year, you have to sell your equity share. Whenever you are selling, you should get back your money. Or if you are buying a particular debenture and the company has already committed that I will give you your principal amount along with 10% rate of return. If you are investing 10,000 today, at the end of the first year, what will be your amount? Amount means principal plus interest, 10,000 plus 10% of 10,000. 11,000 you should get. But at that point of time, the company or the corporate entity unable to meet its obligations. What is its obligations? Your amount of payment. Is it clear? So that happens due to default risk.
Yes, sir. Thank you, sir.
Did you understand?
Yes, sir. Clear,
Okay.
sir.
Yes, Subrat Babu is saying default risk means organization not to able to pay your principal amount, neither principal nor return also. Not only principal. That means if the issue company will not pay its obligations, what are the obligations? Whenever I am buying the stock, let's say you have a company, you are I am buying the stock of your company. If you are unable to meet my obligation, what is your obligations? Your obligation is my payment. If you are unable to pay, then there is some risk due to your default payment. You are the defaulter. Okay. So these all are coming under unsystematic risk. Please remember, these unsystematic risks are driven by the micro factors. Is it clear?
Sir, if we take in the
Did you understand?
liquidity risk,
Yes, sir.
sir,
Yes,
if we
sir.
take in the liquidity risk, sir,
Liquidity risk means what? There may be the variability of the return due to what you can say, liquidity due to unavailability of the liquidity of the security. Let's say you are holding a particular equity share, and when you need money, you should sell your equity share and you can able to get back your money. But if you are holding equity share, I am also investor, I am holding the equity share, or I am holding a particular instrument. Particular instrument means investment instrument. It may be debenture, it may be bond, it may be equity, or it may be preference share. So I must sell at any point of time when I need some amount of money, or when there is some requirement I want to sell. You are holding, I am holding, other investors are holding. Everyone sell it, but nobody is there in the market to buy it. Can you say, is there any liquidity? Because we cannot able to convert our securities into cash or cash equivalent. The risk is due to non-convertibility of the securities to cash or cash equivalent. That is known as liquidity risk. Is it clear?
Yes,
Did
sir.
you understand?
Yes.
No. Okay. Any query? Any more query? Shall we proceed to next?
Yes, sir, you can.
Very good. Thank you so much.
Yeah. You're welcome, sir.
Risk in the portfolio whenever either individual investor or institutional investor is going for investment portfolio. So these are these types of risk that associated with the portfolio. So one should have considered this risk in order to determine the optimum return. It may be credit risk. Credit risk means the potential variability in the returns resulting in the debt issues, not making promised principal and interest payment. It is just like your default risk. Just like your default risk. That means you are issuing, let's say, you are issuing debt instruments to the investors in the market. So what you are doing? You are raising the money from them. You have already committed that I will pay the principal and interest, but you are unable to pay the principal and interest because you have already taken the credit. Okay, loan, but you are unable to pay the payment. So why? That happens due to credit risk. Purchasing power, I have already discussed. This happens due to unanticipated changes in the inflation. If there will be change in the inflation, so definitely risk will be there. So interest rate risk is also there. The potential variability caused by changes in the level of interest rates. As when the interest rate is changed due to the market forces, due to the macro forces or macro factors. So because of that, interest rate risk is there. Liquidity and marketability risk is also there. The risk of the potential variability in the return caused by the lack of marketability. That means you are holding the equity instruments or debt instruments or investment instruments, but you are not in a position to sell it or release it. Why does this happen? Because the same instrument, investment instruments, has lost its marketability. Okay. So this may also be there. Please remember, these are the degree of risk and risk-free rate of return. So this expected rate of return, this can be derived by following the Sapm model. So we'll discuss in detail about Sapm model also. Capital asset pricing model. So this capital asset pricing model consider this terms. That means it consider risk-free rate of return, market rate of return, beta, premium. So here, degree of risk and risk-free rate of return means what? Please remember this degree of risk. In order to determine the degree of, that means by considering the degree of risk and risk-free rate of return, has been derived by William F. Sharpe. Please remember, I will discuss in detail in our next class. So here, expected return can be computed by following this particular equation or particular model. RF plus beta into RM minus RM. What is RF? RF stands for risk-free rate of return. Beta stands for the we can say the risk index associated with the individual security. RM stands for the market rate of return, and RF is the risk-free rate of return. What is risk-free rate of return? That means whenever we are putting our amount of investment in any investment instruments, the risk will be very minimum, or sometimes the risk may be zero. Very simple example I can cite. Suppose you are putting your money in fixed deposit. What is the amount of risk? Once you are putting your money in the fixed deposit, your risk is
Less.
nominal. Very, it may not be exactly zero, but it is very nominal or very
Nominal.
less.
Correct.
Yes or no? It may not be exactly zero. At any point of time, if war-like situation will be there, bank may not run its business. Can it repay back your money? Okay.
Yes.
ଯେମିତି ଆମର ଏଠି କଣ ରଷିଆ ୟୁକ୍ରେନ ୱାର ଚାଲିଛି, କାଲି ସେମିତି ୱାର ଚାଲିବ। ଆଜି ଏ ବ୍ୟାଙ୍କ ଭାଙ୍ଗି ଗଲାଣି, କାଲି ସେ ବ୍ୟାଙ୍କକୁ କିଏ ଆଟାକ କରିଦେଲାଣି। ସୋ ବ୍ୟାଙ୍କ ଆମର ଯଦି ଫିକ୍ସ ଡିପୋଜିଟ ରଖିଥିବ, ଆମକୁ ସେ ଦେଇପାରିବ କି ପଇସା?
No.
Yes, sir.
ଯଦି ଇକୋନୋମିକ କ୍ରାଇସିସ୍ ହେଲା ବି ସେମିତି ହେଇପାରିବ କି? ଯୋଉଟା ମାକ୍ରୋ ଫ୍ୟାକ୍ଟର୍ସ ଆମେ କହୁଛନ୍ତି। But
Sir,
risk
can
generally
please
risk is very less.
Minimum,
Sir,
yes, sir.
Minimal.
Sir, can you please explain again a bit? B for beta, right?
Beta. Okay.
Yes.
I am just explaining.
Yeah.
Did you understand? The risk-free return means what? Whenever we are putting in some investment instruments where risk is very minimum or risk is almost zero. We can say no risk is there. Very simple example. Let's say your post office savings or postal fixed deposits, bank fixed deposits. Once you are putting money, khao piyo so jao, at the end of the period or end of the year, you will get your interest.
Return.
Yes or no?
Yes.
Okay. What is market rate of return? This is the rate of return which is available in the market on a particular investment instrument or financial instruments. So market rate of return will available on equity instruments, preferential instruments, debt instruments, etc. Are you getting my point? Let's say right now you are investing in equity stock. I am also investing in equity stock. So in equity stock market, actually rate of return. Okay. So next is beta. So beta is the risk index of individual security. Please remember, individual security. Let's say TCS Limited is issuing an equity share. So equity share is one individual security. Again, let's say another company is there. Reliance company is issuing. Reliance Limited is issuing one equity share. That is also another individual security. So risk is associated with Reliance company's equity share. Risk is also associated with TCS equities, isn't it? So what is the degree of risk or risk index associated with each and every individual security? That index is known as your beta. Is it clear?
Yes, sir. Yes, sir.
Did you understand?
Yes, sir. Got it, sir.
Then what is the premium? Premium means, please remember, premium is the difference between your market rate of return and risk-free rate of return. What is market rate of return? That means what is the rate of return available in the on the investment instrument in the market. Let's say in the market, on equity instruments, return is 20%, but in fixed deposit, return is 7%. You are putting in fixed deposit, so what is the return you are expecting? 7%. Why I am getting rate of return? Because I am taking the risk. Are you getting my point? Because
Yes, yes,
equity instruments are more risky than the fixed deposits. Yes or no?
yes, that's correct, sir.
So whenever I am assuming more risk, so I must get premium. I must get premium. You are putting your money in risk-free investment instruments, that means fixed deposits. So that's why you are getting 7%. I am
Yes,
putting my money in equity instruments. So I am taking more risk. So
correct,
I
sir.
must get also more premium. That's why I
Correct.
am charging 20%. So what is the difference I am charging? 20% minus 7%.
13,
That is
13%.
13%. That 13% is known as premium. Why I am charging premium? Because I am assuming more risk. When risk is more, return is more. Is it clear?
Yes, sir. Correct, sir.
So expected return of individual security can be determined by this particular model. First, we need to take rate of beta coefficient, then what is market rate of return and risk-free rate of return. So here in the instance case, let's say equity instrument, your equity instrument means market rate of return. Market rate of return of equity instrument is 20%. So here you have to put 20%. If it is a risk-free rate of return, means fixed deposit rates 7%. Under RF, risk-free rate of return, you have to put 7%, and beta coefficient is there. It may be 1, or it may be more than 1, or it may be less than 1. If the beta is more than 1, please remember it signifies that the securities is more riskier. If the beta is equal to 1, it is moderate. If it is less than 1,
Less.
that means the risk is less. Is it clear?
Yeah, correct.
Okay. So this is all about the rate of return. Now I am going to discuss about what are the causes of risk or reasons for reasons of risk. These are some reasons or causes of risk. Why risk is there? Why risk is there? Wrong method of investment. If you are choosing wrong method of investment, definitely risk is there. If you are choosing wrong timing of investment, timing also plays one of the crucial role in case of investment. If you are choosing wrong timing, definitely risk is there. Wrong quantity. So whenever you are creating your portfolio, determine your composition. Let's say 30% from equity, 20% from preferred stock, again 30% from private company debentures, and 30% from government bonds. Let's say that is the idea. If you are not following this ideal rule, that is wrong quantity of investment. Because of that, risk may be also there. Again, nature of investment instruments. So you need to find out nature of investment instrument, whether the investment instrument is more riskier or less riskier. Okay. Again, nature of industry. Industry means sector. So whenever investing also, sector matters a lot. Because sectorial growth is also there. Sector index is also growth index is also there. Nowadays, in service like your IT, banking sector, the growth. That's why if any investor is investing in that sector, automatically they will get more return than manufacturing sector. Are you getting my point? Next one is credit worthiness of the issue. The company or the entity who is issuing the investment instruments. So use the credit worthiness, whether it is having sufficient net worth to meet your obligation. That you need to check. Natural calamities are also there, that also causes risk. Natural calamities like your war, very recently, 2-3 years back, we have already witnessed Corona, COVID. Yes or no? So these are the causes of
Sir,
risk.
wrong timing of
So,
investment means?
wrong?
Wrong timing of investment, second point.
Wrong timing of whenever you are investing, you need to judge the timing actually. Timing means, look here, during a day, let's say stock price at the beginning of the day, stock price will be reflected at the mid of the day, you can able to see the stock price, at the end of the day, you can able to see the stock price. Generally, where you have to see the trends. Whether the price is increasing or whether the stock price is fluctuating or whether the stock price is on the basis of that, you have to take your decision. Let's say right now, stock price is 10 rupees. After 2 hours, it increases to 15 hours. It again gone down to, let's say 8 rupees. So at that point of time, if you are buying, and after 2 hours, immediately it may be peak up to 15 rupees or 20 rupees. Are you getting my point? So timing of investments also matters a lot.
Yes, sir.
Okay. So these
Yes, sir.
are the various causes of risk. This is all about risk. Now, how to measure the risk? We can measure the risk by following two
Sir.
aspects: behavioral
Sir.
aspect, quantitative aspect. So under behavioral aspect, two methods are there. You can go for range analysis or sensitivity analysis, or you can go for probability distribution. In statistics, I hope you have already studied about theory of probability. Yes or no? So by following these two aspects, we can able to measure the risk. This is all about behavioral aspects. That means qualitative aspect. And if you are considering this quantitative aspect or statistical aspect, then you need to consider the standard deviation of the securities or standard deviation of the portfolio, again coefficient of variation of the portfolio in order to determine the risk. Is it clear? So this is how we can able to measure the risk. So
Sir,
whenever we
sir, is there
Yes,
there
please.
any ideal proportion of portfolio investment, stock, preference stock is whatever you are telling?
No, there is no rule of thumb actually.
Okay.
So as I have already told you, on the basis of your method, your investment policy, nature of industry and other factors, you need to take the decision.
Okay,
So
sir.
for that purpose, you need to monitor once to the market by considering the various indicators, then only you can able to determine. Is it fine?
Yes, sir.
So this is all about the basics of investment management discuss. So for today, this much. If you have any query, then welcome. Otherwise, we are going to wind up the session.
Sir, good evening, sir. Good evening, sir. Sir, this is Dr. Akshay Kumar Panda.
Oh, sir, namaskar,
Can
sir.
you
You have
make
already
me
joined.
host, sir?
Okay, sir. You can continue. I am just leaving my class.
Okay.
Okay. Thank you so much.
Okay,
Thank
sir.
you.
Kindly, sir, make me host, sir.
Okay. I am just making you a host and I am leaving. Just a minute, sir.
Okay, sir. Okay, sir.
are the host. Thank you, everyone.
Okay,
Thank
sir.
you,
Thank you.
participants, for
Thank you,
joining
sir.
with me.
Thank you,
Yes, sir.
sir.
Good
Have a
night,
great
sir.
time
Good
ahead.
night.
Good night,
Good night.
everyone. Thank you so much.
You are welcome, sir.
Good evening, students.
Yeah, good evening to you,
Good
sir.
evening, sir.
So today I'm audible or not?
Yes, sir. Now it is
Yeah,
audible.
Okay. Just I'm trying to share my screen. Uh, is the screen visible?
Yes, sir. We are able to see that.
Okay. Students, please wait for 5 minutes. Actually, I'm trying to share the screen. I'm facing
Sure,
some difficulty.
sure, sure, sure.
So,
No problem.
so please bear with me. Uh, uh, is the screen visible to you?
No, sir. Not now, sir.
Yes,
Yeah, we are not able to see that.
visible.
No, no, sir.
Not visible, sir.
Not visible. Now,
No, sir.
not visible.
Yeah, now we are able to see that.
Okay.
Now it's visible, sir.
Okay. 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 So, very good evening to all and one. Actually, my class has been postponed due to the rain. Uh, actually, I was supposed to take the class at 6:30. But unfortunately, due to rain, I was not able to come from the university to attend the class. So please bear with me. And I think the class will continue till 9 o'clock. Uh, you will face no problem.
No, sir.
No, sir, not at all, sir.
Okay. So in our previous class, actually, I had already discussed regarding syllabus. This is the syllabus, Unit 1 and Unit 2. Then Unit 3, Unit 4, and Unit 5. Uh, you must have the syllabus with you. The Unit 1, that is a financial services, in which there is introduction, role and functions, merchant banking, concepts, its functions, growth policy, measures, saving guidelines, future of merchant banking in India. This was the kind of Unit 1, which actually we have already covered. And Unit 2, it is regarding the lease. It's the meaning, importance, types, and the evaluation of lease from the point of view of a leaser and leasing. Then involves buying hire purchase and installment credit, its types, housing financial services, sources, and the policy of housing finance. Uh, Next, Unit 3, that is mutual funds, in which you will read the details regarding the mutual funds, UTI, and venture capital regarding all this. Next, Unit 4, that is regarding your factoring. What happened? Some
Sir, we are unable to see your screen, sir.
Okay, some problem process, I think. Now it is visible or
No,
not?
sir. No, sir.
No, sir.
That's some problem. Now it is visible?
No, sir.
Not
Not.
No, no,
No.
not yet, sir.
discontinued perhaps. Okay. Oh, Zoom has been disconnected. Just a minute. One minute again. What is happening? Is the screen visible now?
Yes, sir. Yes, sir.
Okay.
So this is unit 3.
Yes, yes.
Is this unit 3, sir?
Yes, unit 3, that is mutual funds, concept, different schemes, advantages, UTI, its objectives, regulations of mutual fund, role of UTI in industrial finance, venture capital, its concept and development in India, process and methods of financing. Then unit 4, that is factoring and forfeiting, credit rating, meaning and necessity of methodology of a credit rating, then factoring and forfeiting in detail. And unit 5 is regarding your merger and acquisition, in which merger and takeover main highlights, takeover by bids and acquisition, guiding principles, BIFR and merger, insurance sector, its objectives, role, investment, practice, IRD, role and functions. So these are the total your content of all these 5 units. Out of that, only the first unit we have touched, and some portion is still remaining of the first unit. Okay, so whatever we had discussed in the first unit, we discussed regarding the development of your uh, what there is merchant banking and financial services, its definitions uh, and meaning already discussed. Then role of a financial services, that also we had already discussed under traditional activities and modern activities. Uh, the traditional activities again subdivided into your fund-based activities and non-fund-based activities. And under fund-based activities, these were the activities which we had discussed in the previous classes, but due to no PPT, actually you are not able to note everything clearly. But as I have shared this PPT now, so you can save this PPT also. And you see, these are the fund-based activities, that is underwriting of shares and debentures, then dealing in foreign exchange market activities, lease financing, hire purchase, venture capital, factoring and forfeiting, then housing finance, insurance services, venture capital financing, dealing in secondary market activities, participating in money market instruments like your treasury bills, discounting bills, and the commercial papers. These also we discussed. Uh, then non-fund under non-fund based activities, the management of a capital issue, that is a pre and a post issue management, we have already discussed. Arrangement for the placement of a capital and debt instruments with investment institutions, already discussed. Arrangement of funds from financial institution, arrangement of working capital for clients, and assisting in the process of obtaining government clearance, we had already discussed in the previous classes. Then under modern activities, rendering the project advisory services, right from the preparation of the project report till the raising of funds for starting the project, planning for mergers and acquisition and assisting for their smooth carry out, directing corporate customers in capital restructuring, and acting as a trustee to the debenture holders, uh, then recommending suitable changes in the management structure and management style for achieving better result, portfolio management of large public sector takings, capital market services such as your clearing services, registration and transfer, collection of income on securities. These also we had already discussed in the previous class. Then regarding the function of financial services, these functions already we had discussed. If you have any doubt in them, then please ask so that I will clarify it and we'll go ahead. Yes?
No, sir, you can continue for unit 3.
Then actually in the previous class we had started that is the merchant banking.
Yes.
This what is okay, the term merchant banking, as I told you, that is actually this term was developed in your Italy first, and but in India, particularly merchant banking definition is framed in the SEBI rules 1992. This is the definition, enlarged definition, which I had already discussed in the previous class. And I also made you clear the meaning of this. In 1969, actually, this Greenlist Bank concerned merchant banking division in India, and the bank started the activities relating to the public issue of securities. They also undertook the financial consultancy services, and in 1973, the State Bank of India started merchant banking services, and finally in 1974, the ICICI also started this merchant banking services. After 1975, many merchant banking organizations came into the picture, and the sponsors for these organizations were by banks and financial institutions, non-banking financial institutions, NBFCs, then brokers, and so on. Consequently, the scope of the merchant banking activities was widened, and nowadays you will able to see. Actually, as I already told you, this concept was started initially uh, uh, regarding the new issue capital regulated issue provision of the Capital Issue Control Act 1947 and the rules made under it. And in 1992, this act was replaced. The protection of the interest of the investors was transferred to the Security and Exchange Board of India, that is SEBI. There are various regulatory measures covering both the intermediaries as well as the activities were introduced by the SEBI for strengthening the operations of the new issue in the country. And many intermediaries who play an important role in the process of selling new issue, they are also emerged. Out of them, the merchant bankers are the most important one. The merchant bankers, particularly, they are divided into 4 categories. Okay. The merchant bankers of this category, category 1, category 2, category 3, and category 4. Out of this, the first category, that is category 1, the merchant bankers belonging to this category can carry on any activities relating to the issue management. These activities are preparation of a prospectus and other information relating to the issue, determining the financial structure, tie up with the finances, then final allotment of securities, and a refund of the subscriptions, if any. So these are the functions of the category 1 merchant bankers. That means the merchant bankers of this category 1, they can do all these functions. Is that right?
Sir, preparation of prospectus means?
Preparation of prospectus, actually in the corporate sectors, they don't have the knowledge of how to prepare the prospectus. As I told you, what is a prospectus? A prospectus is an invitation by the company to the public to contribute to its shares or debentures, right? So a prospectus, as it is an invitation to the public, so there must be some good style how to prepare it. That means what are the how the important things should be highlighted there. What is the format of writing a prospectus? So this is one art of preparation of this prospectus, which is actually the corporate sectors, they don't have any knowledge. So the merchant bankers particularly, they have a thorough knowledge regarding this, so that say they help these corporate sectors to prepare the prospectus. Is that clear?
Yes, sir. Thank you.
Okay, so these are the few most important functions of the merchant banker of a category 1. Merchant bankers, they are subdivided into 4 categories. Okay, this is the first category, that is category 1, merchant bankers, and their functions particularly related to the issue management only. Relating to the issue management means they are supposed to do these activities: preparation of a prospectus and other information relating to the issue, determining the financial structure, tie up with the finances, final allotment of securities, and a refund of a subscription, if any. Okay, then we'll go to the category 2. Under category 2, you see this type of merchant bankers, they can act as the advisors, consultants, co-managers, underwriters, and portfolio managers. A little bit there is a distinction between the category 1 and the category 2, because the category 1, they are only concerned with the issue management, but here they can act as advisors, consultants, co-managers, underwriters, and portfolio managers. Is that right?
Yes, sir.
Yes, sir.
And in the category 3, merchant bankers, particularly those who belongs to this category, they act as underwriters, advisors, and a consultant to an issue. Okay, they cannot act as portfolio managers. Right? Little bit of distinction between these categories. So why this type of a distinction made between the categories, that also I will tell you. So this is the category 3, and in the category 4, merchant bankers of this category can act only as advisors and a consultant to an issue. Right? So these are the 4 categories of merchant bankers. Actually, when the merchant bankers, they have started their operation, there were all these 4 categories. But as the days going on, then the SEBI guidelines become stricter, more strict and more strict. And finally, what happened? Now, all the merchant bankers are restricted to only the category 1. Those merchant bankers belonging to the category 1, they are now recognized by the SEBI. Other categories of merchant bankers, they are not recognized by the SEBI, and they are not coming under the purview of the SEBI. Is that right?
Yes, sir. Yes, sir.
Good. Then we'll discuss the functions of the merchant bankers. The functions of the merchant bankers are a few. That is what I have noted down, some 15 functions, important functions. Apart from them, some more functions are also there. But out of all these functions, these are the prominent functions, important functions, which I have listed. Here 15 functions are there. 1, 2, 3, 4, 5, 6, 7, 8. Then in the next slide also, up to 15. Okay. One by one, I will discuss them. So don't worry. The first one, that is your, what was the first function? That is corporate counseling. Okay. First one is your corporate counseling. Second one is a project counseling. Third is a pre-investment studies. Fourth one, capital restructuring. And fifth, credit syndication and project finance. Sixth was issue management and underwriting. Seventh, the portfolio management. Eighth, working capital finance. And then acceptance of a credit and bill discounting. 10th, merger, amalgamation and takeover. 11th, venture capital. Then 12th, lease financing. Then foreign currency financing. Then fixed deposit broking and mutual funds. So these are the few important functions. That means the merchant bankers, they are providing these services, and these are their basic functions. Okay. So out of these, we are first will discuss regarding your corporate counseling. So what is a corporate counseling? A corporate counseling means what you see. It is a set of activities which the actually merchant bankers they are providing, and it is especially for the efficient running of a corporate enterprise is known as corporate counseling. Okay, so the merchant bankers who are guiding with these actually corporate sectors, basically they are doing these two types of important functions under this corporate counseling. That is diversification based on the government's economic and licensing policies. And second one is appraisal of a product lines, analyzing their growth and profitability and forecasting future trends. In the first, you see that there is a diversification based on the government's economic and licensing policy. Actually, whenever our there is certain economic changes, that means change in the economic scenarios. Due to that, the government making some stringent policies, so that what new licensing policies are required, day by day registration process is required due to the introduction of your GST. Then there is a registration process. Then as per the WHO GMP certification, there is another licensing policy is there. So day by day, what the business doing business becomes very difficult. Why? Because our economic scenarios is becoming a little bit complicated, and there is many government interferences, and there is a licensing policies. Government has framed the licensing policies in such a way so that it will become difficult for the corporate sector to obtain these licenses. And these merchant bankers, particularly, they are what helping these corporate entities to obtain these licenses. Okay, and the second one is your appraisal of a product lines, analyzing their growth and the profitability and forecasting future trends. Now, in the in this corporate world, most of the corporate houses, they don't have adequate knowledge regarding the product lines and how to analyze their growth and profitability each and every product, and forecasting their future trend, whether in the future they will be demanded in the market, there will be good demand in the market, or they will be obsolete in the market. For this purpose of there is what forecasting. So all these functions, that is appraisal of a product lines, analyzing their growth and profitability, and forecasting the future trends of the product lines. This job also carried on by the merchant bankers. Next one is your diagnosing sick units and their revival prospects, and rehabilitation by way of modernization and diversification, suggesting suitable strategy for improving their production technology and financial structure. Actually, we are listening that new companies have been formed, but at the same time, you see most of the companies, they are becoming sick. So what is the reason for the sickness of this company? That they are analyzing. and they are also helping these SIG units for the revival, for their revival. Okay, and they are suggesting any suitable strategy for improving their production technology and financial structure, arranging funds for rehabilitation through banks and financial institutions, monitoring of rehabilitation schemes, and assisting takeover of securities. Suppose after doing so many things, but this security is not able to recover, then they are arranging for its takeover, जो कि होता है आपका acquisition में होता है, case of acquisition or takeover. So, is this clear? The first function under the first function, these subpoints, all the subpoints I have discussed.
Yes.
In any point there is any issue?
No, sir.
Okay, what is your no issues? Okay. Now we'll go to the second one, that is the project counseling. And the project counseling, that is project counseling means what? Particularly whenever you are planning for any business activities, then you need to prepare a project for that. And the project will approve only if it is feasible, right? Once you will prepare a project, this project will be approved only it is feasible. So this is called feasibility study of the project. Okay, the feasibility study. Here you see various factors are there: financial, economical, commercial, technical points are many points are there, and all these points should be discussed in detail. And for this purpose, you see there a review of a project idea, conducting feasibility study, and providing advice for implementation. Next is you're providing assistance in the preparation of a project report, conducting market survey, and obtaining government consents, that is approval or licensing policies or permissions and grants, whatever, for the implementation of the project. And providing guidance in making the investment in Indian projects in India and abroad, and arranging and negotiating for the foreign collaborations or amalgamation, mergers and takeovers, if any. So these are the part of your project counseling. Okay, what is the main function? Project counseling. And these are the sub functions of your project counseling. Is that clear?
Yes, sir. Clear.
Good. Next is your pre-investment. So pre-investment study. Pre-investment study means it is a detailed what feasible study to evaluate the alternative avenues of the capital investment in terms of a growth and profitability. And a few activities which are involved in this pre-investment study are analyzing the environment and the regulatory factors, identification of the raw material sources, then estimation of a demand, and estimation of the financial requirements. Okay, so these are the few steps of a pre-investment study. Next is your capital restructuring. Under capital restructuring, I think in the previous class also we had discussed a little bit regarding the capital restructuring. Actually, whenever the corporate sector needs any capital restructuring, actually it is done with a view, particular objective. So capital restructuring aims to reduce the cost of capital, as I already told you, and maximize the shareholders' wealth. Here, two objectives are there. One is your to reduce the cost of the capital and maximize the shareholders' wealth. Here, one question will be what creeping into your mind: how to reduce the cost of the capital? Capital restructuring, how it aims to reduce the cost of the capital? You see, just I am giving you one example. Suppose you need 1 crore of a capital. For this purpose, there are three alternative sources. One, either you can issue equity shares. Second one, you can issue your debentures. Debentures carry a 9% rate of interest, and you can also arrange the bank finance for that purpose, which is 12%. Okay, so what you will plan? Whether you will issue shares, or you will issue debentures, or you will arrange it from the bank. Tell me.
Yes, sir. Can you come again, please? Question.
So suppose you see three options are there. Suppose you are the finance manager of any corporate sector, and uh, that company particularly it needs 1 crore capital. Okay, this 1 crore, for this purpose of 1 crore capital, there are three options in your hand. First, you can issue equity shares to the public. Actually, equity shares they do not carry any rate of interest or dividend. And the second one is a debenture, issue of a debenture. You can issue the debentures carrying a 9% interest for annum, and you can also arrange the bank loan which carries 12% per annum. So, out of these three, which you will prefer and why?
Sir, as per my knowledge, I will go with the equity.
You will go for the equity. Why? Please justify.
Because sir, equity is based on what offered by company per
Mhm.
share. I mean, and it is not based on that any interest we have to pay monthly. If company organization will be profitable, then it will be valuation. Then you can pay as a dividend, either something like that, profitability surplus amount. So if I'm going with the bank, then I have to, I mean, loan there will be at least I have to pay interest and as usual debenture also. That this is my opinion, sir, as per my understanding.
Good. But here one implication is there. If you issue the shares and if you not pay them the dividends, then what image will be of the company? The company's image will be what very bad in the market. As a result, its value will decline in the market. Its shares value. अगर share का value अगर कम हो जाएगा market में तो network तो भी कम हो जाएगा company का. ये भी
Yeah,
पता है.
that's correct, sir. That's correct, sir.
So
But
that is why actually as a finance manager you should try not to devaluate your company. For this purpose, what you have to plan a combination of all these three so that the cost of the capital should be very minimum. इसका मतलब क्या होता है कि इक्विटी भी कॉस्ट होता है एटलीस्ट टू द इक्विटी शेयर होल्डर इफ सपोज द कंपनी will earn no profit in a year, so is it advisable to not to declare dividend?
yes, sir.
The company will not earn profit this year, but whether it is advisable that a company will not pay dividend to the shareholders?
Yes, sir. If there will be not profitable, then how can we pay? Because as per that
No,
profitable, then we have to plan for dividend pay.
no. Actually, it's the wrong idea. Actually,
But preference, if
uh,
you have preference and there is a mentioned rate of at least, then we have to pay. But the equity,
uh,
I think so, but I'm not sure about that. But as per my knowledge, preference we have to pay. Other we have to accrue that. Otherwise, for
actually,
equity, that's
yes. Yes, you see, if it is a preference share, then actually the rate of dividend has been already mentioned in the preference shares.
correct, correct,
That is
correct. At the
why
time of issuing the certificate.
so we are supposed to pay them a dividend. But you see, the equity shareholders, as they are the owners of the company, so why the owners they are interested to invest their capital in the company?
Sir, can I elaborate two things? As per equity share, there can be a shareholder. That does
Mhm.
not mean that will be a owner. I mean promoter. With promoter definition different, and the equity share. Suppose I am
Aha.
since long bank, long in one organization, I can be in shareholder as a equity. I can possibly as can be shareholder, but I cannot be a owner. I mean promoter. Which promoter definition definite as per my knowledge. It
No,
is
no, no,
differentiate,
no.
and as a long-term service I have given, I can make a shareholder in that organization.
No, if it is equity shareholders means it is the symbol of ownership. Okay, if you are
But as per
if
sir,
you
as per ROC, as per company law, that does I don't think
are
so. That mean of that.
no. Why not? Because you see, general meeting will be there, and in the general voting meeting, you are exercising your power, voting
Yes,
right.
yes,
If
yes.
you are equity shareholder, then you are exercising your power
But it is
of
only
owner.
for. But sir, it is only for EGM and AGM. It's not for vote minutes. Am I right, sir? The shareholders, sir, there is a different thing. So shareholders has only rights to vote in the EGM and
Huh?
AGM. And AGM is
Yes,
held once a year as a private company. And EGM,
yes.
as requirement might be create any, how many times as per a requirement are given. But only shareholder that's
Okay.
required in that time as AGM or AGM, but not board minutes.
But what is the importance of a AGM? In the AGM, you see managing director will be appointed. Okay, all the directors will be appointed. The auditors will be appointed. The dividend will be declared. All the important things will discuss in this meeting. That means what?
But
Directly or
sir,
indirectly,
but
the
sir,
AGM actually. Yes,
but sir, then I have to
yes.
elaborate that is
Mhm.
depend on what percentage you are going to buyback of shares and dividend, because the buyback is less than 10%, it does not require any approval from shareholders, and it is more than 10%, then it is required for shareholder. It is required less than 10%, then board has rights to, they can just release and conclude into that thing without approval of shareholders. That's dependent on how many percentage you are going to share buyback of shares and dividend. As per my knowledge, might I be wrong, but as per my knowledge, what I just updated in this area, I mean, as per company law. Hello.
Is it audible now?
Yes, sir.
Okay. Due to certain network issue, actually I have been disconnected.
Yes, sir. Network issue.
Yeah, yeah, yeah. So actually, you see, all the important items discussing the exit and uh, exercise in rate, both their voting rate, they control the management of the corporation. So that equity shareholding means it is the owners. Okay, in ordinary language, equity shares means it is what a share of ownership, but nothing else. So if the shareholders, if the shareholders are exercising their control over the management, that means what they are owners. We cannot deny that they are not owners. Am I audible or any problem there?
But not, sir. We are not
Yes, sir,
getting
we are not,
properly.
it's not clear.
We cannot see your slides.
You are not
Voice is
able to
also
see
not clear.
your screen. I wonder also we are not getting properly your voice. Sir. Actually, there's some network issue might be.
Okay. I am trying to reconnect it.
Sure.
Again, it has been disconnected, I think. Please give me 2 to 3 minutes to reconnect this. Now the screen is visible.
Yes, sir. Yes, sir.
Okay, and let us continue. Actually, what was our discussion regarding the ownership? Actually, shareholders, that is equity shareholders, are the owners of the company, and actually, if they are dissatisfied with the performance of the company, then they have a right to sell their shares to other persons. So that what they are selling their shares in the stock market. So that in order to keep the shareholders satisfied, although the company earns no profit in a particular year, but the company is planning to give them certain dividend. And that is why whenever the company earn huge profit, they are not distributing the entire amount as a dividend, rather they are keeping a part of that to be distributed at the time whenever the company will sustain loss.
Excuse me,
Right?
sir.
It's
Excuse me, sir. I have one question. If
uh,
there is no profit, then how come a company able to provide the dividend?
The company will not earn profit. Suppose the company is not earning profit in that particular year, but there is a vast reserve in the company. That means what surplus, vast surplus and reserves are there in the company's balance sheet, so that company can distribute the dividends out of that,
See, if there is the initial
right?
period of the company, then
Okay. If it is the initial period of the company, then it will be stringent for the company to declare the dividend. But continuously, if the company will not give dividend, then what will be the situation? The shareholders, all the shareholders, they will
Sir,
transfer their holdings. As a result, what there will be? Yes.
सर इसमें एक क्लैरिफिकेशन एक थोड़ा सा और चाहिए एलेबरेट थोड़ा, जैसे कि
हाँ
इक्विटी शेयर जब इशू करते हैं, जैसे कंपनी ना इक्विटी शेयर इशू किए है,
हाँ
आज देयर इज नो
हाँ.
मेंशन रेट ऑफ इंटरेस्ट इन द शेयर सर्टिफिकेट, राइट सर?
No, not mentioned. Yeah.
एंड फॉर प्रेफरेंस शेयर इट हैज बीन मैंडेट, राइट?
Yes.
जो इक्विटी शेयर जो इशू किए हैं, तो जो शेयर होल्डर्स आर, तो है ना,
हाँ,
इक्विटी कंपनी हैज इशू दो शेयर्स है ना, जो इक्विटी शेयर, तो उसमें जब
yes,
कंपनी कोई
yes.
रेट ऑफ इंटरेस्ट फाइनल नहीं किया हुआ है, तो प्रॉफिट है नहीं है, तो हाउ
हाँ,
कैन दे डिस्ट्रीब्यूट द,
हाँ,
दे कैन अक्रूड द प्रॉफिट, कोई रेट,
हाँ,
मतलब व्हाट वाज द परसेंटेज दे हैव टू अक्रूड दैट इफ देयर कंपनी इज लॉस,
हाँ,
तो दैट इज
हाँ.
व्हाट वाज द परसेंटेज फॉर द प्रेफरेंस शेयर, इट हैज बीन मेंशन वी हैव टू अक्रूड द एक्सपेंसेस.
Okay, you see
But
one
what
thing.
was the rate
Uh,
of interest we have to consider as a dividend and we just want to just elaborate on
rate
that.
of dividend. This rate of dividend, actually, the rate of dividend has been actually proposed. The rate of dividend has been proposed in the annual general meeting, right?
Yes.
Rate of dividend has been proposed. And what is the shareholders? The shareholders can reduce this rate, but cannot increase the rate of dividend. दिस इज प्रोविजन इन द कंपनीज एक्ट. समझ
Okay.
में आ रहा है
Okay.
ना? तो
Okay, sir.
इसका
Okay.
मतलब क्या होगा? द बोर्ड ऑफ डायरेक्टर्स दे विल गिव द प्रपोजल दैट द rate of dividend what we have decided it should be 15%. So the shareholders can tell no, we don't need 15%, you make it 10%, then it's okay, but they cannot ask for giving more rate of interest,
Sir,
right? More rate of a dividend. Huh,
yes,
more rate
yes,
of
sir.
dividend because the rate of dividend is not fixed there. The
Okay.
thing is that as the directors they will declare the dividend in the AGM. If continuously suppose if it is a new company, then the shareholders they will be satisfied. Yes, this year there is no profit. Let us hope for the best, and the next year we'll expect something. In the next year also the company will earn no profit, and the board of directors they will declare no dividend. Then what happens? They will think that we have invested so much of our money in this company, but the previous year there was no dividend. This year also there is no dividend. So why we will invest in this company? Better we will divert our fund.
Yes,
ये
sir.
भी
Fair
आ
enough, sir.
सकता है आपके दिमाग में. तो
Yes, sir.
इससे
Fair
क्या
enough. Fair
होगा?
enough. Fair
इससे क्या
enough.
होगा कि जो कंपनी का जो शेयर होल्डर्स होता है, दे विल कैरी बैड इंप्रेशन अबाउट द कंपनीज परफॉर्मेंस, so that they will divert their funds. and this will finally lead to the devaluation of the shares of the company. Fearing
Okay.
this devaluation, actually companies क्या करते हैं? A company they are trying to give a steady जो steady dividend policy actually they are preparing. That means suppose the last year they have given 10%, this year either 10% or 1% more than that. Okay, and whenever the company earns huge profit, at that time they are not declaring the entire amount as dividend, but rather they are transferring a major part, a major portion of this dividend to the surplus, so that it will help them in the future to follow a steady dividend policy, so that at least to keep them satisfied. To whom? To the equity shareholders,
Good shareholder. Correct,
right?
sir. Correct, correct.
Huh.
Sir,
Actually,
sir,
that is.
yes, sir.
हाँ,
Sir,
yes.
got sir, समझ में आ गया. But sir, as a
Okay.
shareholder, what they will prefer? I mean, for dividend or buyback of shares? What will be more
Uh,
beneficial for shareholders?
you see, whenever the actually buyback, if it is a buyback, you see who will be benefited. The shareholders are not much benefited, but the company will be benefited. Actually, the very purpose of the buyback is that a company needs to withdraw its capital from the market. Okay, by that there will be what, a reduction in the capital. द कंपनी को क्या चाहिए? उसको कैपिटल रिडक्शन करना होता है, इसीलिए तो बायबैक करते हैं, है ना?
Yes.
बायबैक से क्या होगा?
बायबैक से
कैपिटल रिडक्शन
कैपिटल
हो जाएगा
पेड अप कैपिटल
एक्चुअली.
और लेस हो जाएगा.
हाँ, पेड अप
सर,
कैपिटल लेस हो जाएगा. अभी
हाँ.
पेड अप कैपिटल जो लेस होगा, तो फाइनली वो एडजस्टमेंट कहाँ से होगा? क्योंकि आपका तो कैपिटल साइड तो कम नहीं हो जाएगा ना.
नहीं, अगर सर some example, I am a one shareholder in X company, right? And I have purchased the share as
यस,
paid
यस.
up for share 6,000, correct? And if your X
हम्म.
organization is going to buyback of shares, they have to valuation of the
या,
shares, right?
या, या.
Without valuation, they cannot release the share, they cannot do the share buyback, right? So that time,
यस,
the
यस.
valuation the company will be that time it might be 50,000, 1 lakh, something like that. Then I have just
हाँ.
purchased in six at the rate per share 6,000, and I am getting at the time back. If I'm just I have 2,000 shares, and I'm just going to as per my going to share 100 shares, then I will be definitely be
या.
benefited because 1 lakh I'm getting 9,400.
Yes, yes. Yes,
Then
you
I
will be
will,
benefited as a shareholder. As you told, actually, as a shareholder, you will be benefited, but not much benefited as the company. Why? Because whenever company plans for the buyback, it has a greater objective. It has a greater objective, and to satisfy that greater objective, the company what makes its buyback. एक बार कंपनी अगर डिसाइड करता है बायबैक करने के लिए, कंपनी का जो शेयर का जितना कॉस्ट होता है, उससे भी ज्यादा भी कंपनी पे करके किसी भी तरह बायबैक करता है शेयर्स. ओके, तो
जी सर, जी
उससे
सर.
क्या होता है, क्या कैपिटल रिडक्शन होता है, और ये कंपनी का जो फाइनेंशियल रिस्ट्रक्चरिंग जो होता है ना, फाइनेंशियल रिस्ट्रक्चरिंग
जी
वही
सर.
ऑब्जेक्टिव होता है. और उसी ऑब्जेक्टिव को सेटिस्फाई करने के लिए पॉसिबल कंपनी आल्सो पे समथिंग मोर देन द मार्केट वैल्यू ऑफ द शेयर्स. तो
ओके, ओके.
उसी शेयर का जो मार्केट वैल्यू होता है, उससे भी ज्यादा देकर भी कंपनी उसको खरीद लेता है कभी कभी, जब उसका
ओके सर.
जरूरत होता है.
ओके सर. ओके सर.
Okay,
थैंक यू
and
फॉर द क्लैरिफिकेशन. थैंक यू सर.
okay. So now we are discussing regarding the capital restructuring. What is the role of the merchant bankers? These merchant bankers they provide certain services regarding determination of optimum capital structure, conforming to legal requirements. According to the legal requirements, capital structure क्या होना चाहिए, ये वो decide करते हैं. Then getting the consent of the controller of the capital issue for the capitalization ऑफ रिजर्व. जो कंपनी का ह्यूज रिजर्व जब रहता है, तो ह्यूज रिजर्व को क्या करते हैं, वो कैपिटलाइजेशन कर देते हैं. दैट मींस व्हाट दे आर टर्निंग इट इनटू द कैपिटल, और इट मे बी कन्वर्टेड इनटू डिबेंचर्स और एनी अदर थिंग. इसका मतलब क्या होता है कि कैपिटल स्ट्रक्चर में थोड़ा चेंज करना चाहते हैं. तो ये कैपिटल स्ट्रक्चर चेंज करने के लिए अगर किसी का कंसेंट चाहिए, जैसे कंट्रोलर ऑफ कैपिटल इशू, उनका कंसेंट का भी जरूरत होता है. ये सब एक्चुअली वो जो मर्चेंट बैंकर्स दे आर providing these services. Okay, is that audible?
Yes, sir.
Yes, sir.
Okay, the next slide. Why it is not?
Sir, actually, we have diverted from that main question, sir. As a finance manager, what we should choose, whether equity or preference or debenture or debt.
Bank loan, bank loan.
Actually, I asked you such a question whose answer is so elaborated, and if I'll discuss upon that, you will consume some more than one or two classes. Okay, let it be this question to be up to you, so that if at the end of this session, that means ये हमारा जितना क्लासेस होगा खत्म होने के बाद अगर टाइम हमारे पास कुछ बच जाएगा, so that we will have a discussion upon that. Okay, it's a good
Okay,
question,
sir.
and there will be what much discussion upon that. Okay, so let us concentrate on the present issue, that is regarding the merchant bankers service which they are providing as a capital restructuring. इसका क्या हुआ? Not going on. Okay. Then what that is a credit syndication. So credit syndication, it is also another function. It refers to the activities which are connected with the credit procurement and project financing aimed at raising the Indian and foreign currency loans from the banks and the financial institutions, and they are collectively known as a credit syndication. All right, the entire process, the arranging credit from the starting from the preparation of your project report for the finance, and what arranging the financer, even though it is Indian or foreign currency loans from any financial institutions or banks, the entire process is called your credit syndication. And ये credit syndication में बहुत सारा activities होता है, जैसे कि estimating the total cost of the project and drawing up a finance plan for the total project cost, then preparing loan application for financial assistance from term lenders, financial institutions, banks, and monitoring their progress, including the pre-sanction negotiations, then selecting institutions and banks for the participation for financing. ये जितना सारा functions है ये credit syndication में आता है, and these functions are one of the important function of your merchant bankers. Then regarding issue management, इसमें कुछ ज़्यादा discussion करना नहीं है. Why? Because we have already discussed regarding this. That is जो issue management होता है, generally underwriting is concerned with the activities of the management of the public issue of corporate securities. जैसे कि equity share, preference shares, or debentures or bonds to procure money from the capital market. Already we have discussed regarding this. So no more discussion is required for this point. Next
Sir,
one is portfolio management.
Sir, what?
Yeah.
Excuse me, sir. Sir, what exactly underwriting here?
Underwriting, okay, I have also elaborated in the previous class, but you are present in the previous class or not, I exactly cannot remind. Okay, again, I am giving you a brief idea about the underwriting of the shares. Actually, whenever the company issue shares, there is a issue size. Okay, there is a issue size. Suppose the company wanted to issue 50,000 equity shares. Okay, as per the company law, the company should receive the minimum application, that is called a minimum subscription, right? ये 5% से 7% या 15% 13% कुछ भी हो सकता है. That is as per the company's act, it will be decided. तो minimum subscription से अगर कम हो जाता है application, then the entire issue will damage. That means become worthless. That means the company is supposed to refund the entire amount which has been collected from the prospective shareholders.
Okay, sir.
Able to understand? Now,
Yes, sir.
what will happen in this scenario? Actually, the company will not able to issue the shares, right?
Okay.
So that in that fear, that means there is also fear now that whether the company will not receive the minimum subscription. If the company will not receive the subscription, then the entire subscription will be cancelled. That
Yes,
is
sir.
why what they are before this issue, before this issue, they are dealing with the merchant bankers who are actually providing the service of underwriting. In this process, underwriting is a process by which the underwriters, they are giving a guarantee that if the application number of applications they will receive for less than the minimum subscription, then the rest shares they will purchase, so that their minimum subscription will be complete, and there is no fear for the company regarding receiving less than the minimum subscription. Is that clear now?
Yes, I got it, sir. Thank you.
Yeah, very good. So the next point, that is portfolio management. In the portfolio management, also we had discussed in the previous class a lot of things. But here you see a few services which are particularly related to this portfolio management are actually taken over by these merchant bankers, like providing advice and selection of the investment, carrying out a critical evaluation of the investment portfolio, collecting and remitting the interest and the dividend on investment, undertaking investment in the securities, safe custody of securities in India and overseas, undertaking review of a provident fund, investment, trust investments, etc. But one thing I need to ask, actually in the previous classes already I had discussed regarding the portfolio management, but whether you people are able to understand what is the exact meaning of this portfolio management, or anybody having any doubt, so that I need to clarify you. Anybody having any doubt regarding the portfolio management?
No, sir, I do not
No,
have
sir.
anybody
I
else.
think we are clear. I think so, Krish.
So everybody understood
Yes.
the portfolio management.
Yes, sir.
Okay, no issues. Then we'll go to the next. That is working capital finance. Working capital finance is the fund required to meet the day-to-day expenses of an enterprise. And here, the activities which are required to be carried on by the merchant bankers are assessment of working capital requirements and facilitating the sanction of a credit facilities or speed disbursement. Why? You see, actually the entire capital requirement of the organization may be broadly divided into two categories. One is your fixed capital requirements and another is working capital requirement. The fixed capital requirement is meant for the time of starting of the business. That means for the acquisition of land, building, plant and machinery, and all these things. For this purpose, a huge fund is required. That is what this is fixed capital. And after acquisition of all this, then the company need to run, and for this smooth running of the business, actually they need raw materials, then your overhead expenditures, all these are supposed to be maintained. And for this purpose, actually they need certain finance. And what is the exact requirement that they cannot assess perfectly? That is why this what merchant bankers, they are helping in the assessment of the working capital requirements. And if there will be any requirement, financial requirement, then they are also facilitating the sanction of the credit facilities and its speed dispersal. Is that clear?
Yes, sir. Sir, it's OD, CC that were under working capital. Am I right?
CC,
Yes, cash credit.
cash credit system.
OD overdraft facilities.
You
That
see,
should.
actually, overdraft facility, it is a temporary. It is for very temporary, very small time period. Okay, it will solve no purpose of this working capital requirement. But you are telling regarding the CC, it's okay. The CC, that is cash credit, it can be, if it will be arranged, then it will be better. It will be better because what they will sanction you the CC limit, and within that limit you need to continue your business.
So
CC can be.
that will cover on working capital, right, sir?
Yes. CC is
Okay, okay,
especially meant
fine.
for working capital only, because of
Sure.
for the fixed capital requirement, CC will serve no purpose, right?
Yes.
And for the working capital purpose, CC is good. Okay,
Okay.
next one is acceptance credit and bills discounting. Now it is actually the function of a bank's modern banking system, but even the merchant bankers, they are also helping their corporate clients, particularly in the acceptance of credit and bills discounting. And in these activities related to the acceptance and discounting of bills of exchange and advancement of loans on the strength of such instrument, it can be facilitated also by the merchant bankers.
Sir, acceptance credit.
Uh, yes, acceptance and discounting. Once the bills of exchange has been drawn, then it needs to be accepted by the party. That is the acceptance. And after the acceptance, either you can hold that bill till the date of maturity, or you can get it discounted with the bankers immediately, and you will get the finance for that, so that you can use that fund in your business. Okay.
Yes, sir.
It will,
Thank you.
its detail will be in the chapter. That is, you must have that chapter, that is Negotiable Instrument Act. Under Negotiable Instrument Act, that is bills receivables are there, and particularly the bills of exchange and promissory notes. These are a few instruments, right? I think
Yes, sir.
the time is over. Time is over, and my system is also out of battery. So let us conclude the class here.
Yes, sir.
Okay.
Thank you,
Yes,
sir.
sir. No
Good
problem.
night, sir.
Thank you, sir.
Okay. Okay.
Good night,
Thank
sir.
you so,
Good
so
night,
much.
sir.
Good night, all of you.
Good night, sir.
Good night, sir.
Good night.
Okay, bye, friends.
Students, you can leave. You can leave the class. I am trying to leave.
Okay, sir. Okay. Thank you.